Chapter 4. Trading Japanese Candlesticks. Before we start, smash subscribe plus like plus share equals more content like this. Charts may be deaf and mute, yet they still communicate very well. Candlestick formations are the sign language of the market. They frequently tell the trader where U-turns or reversals are and where the market is going. Most beginner traders prefer learning how to read charts using what is called a Japanese candlestick, which monitors price movement against time. There are three types of charts traders can refer to: a line chart, a bar chart, or a candlestick chart. Until recently, bar charts dominated the financial industry, but now even the world's top traders are using Japanese candlestick charts for the additional information they can provide. The history of Japanese candlesticks. The period 1500 to 1600 in Japan was known as Sengoku Jidai, or the Age of War. Military confrontation had become a way of life in that country as feudal lords fought for control of rival territories. Over a period of 40 years, 1534 to 1582, 16th century, three charismatic generals, Nobunaga Oda, Hideyoshi Toyotomi, and Ieyasu Tokugawa, unified Japan. Once somewhat relative peace had been established, several new opportunities for expansion developed. It was during 1600 that the concept of the Japanese candlestick was being explored, tested, and used in monitoring prices in the rice markets. Because there was no standardized currency, the price of rice became the predominant medium of exchange, or currency. In the late 1600s, the rice exchange was formed to regulate trading proceedings. By 1710, there were more than 1,300 rice dealers. Rather than just deal in actual rice coupons were issued, and these became one of the first forms of futures contracts ever traded. Similar events took place in other parts of the world. There was the tulip mania that swept the Netherlands in the early 1600s, which also involved a form of futures contract. During this period, tulips became the standard medium of exchange and became even more valuable than gold there. The popularity of these tulip coupons were drawing attention around the world, and other countries began to catch on to this effective way of trading. Rice coupons in Japan became significant, with a bale of rice being the standard amount to be traded. By 1749, there were approximately 110,000 bales of rice traded via empty rice coupons, although it is believed there were only about 30,000 bales in all of Japan. An empty rice coupon became a form of a futures contract, a coupon for rice that may not even be planted or harvested yet. The rice is traded for a specific future date, as if it was grown and going to be delivered to that person on that future date. Today, futures trading is a multi-billion-dollar industry. In America, most futures trading for commodities occurs in Chicago, at the Chicago Mercantile Exchange, or CME. But where do Japanese candlesticks fit in? Munehisa Homa was born into a wealthy Japanese farming family in 1724. Homa had an aptitude for business and would eventually become a dominant trader in the Japanese rice market. Although candlesticks were not actually developed by Homa, he studied the psychology of investors and formulated several key trading principles. These concepts evolved into the candlestick charting techniques that we know today. Candlestick charts were originally plotted painstakingly by hand. This labor-intensive step, as well as the fact that many Japanese traders could not properly communicate or share their trading methods due to language barriers, meant that the use of Japanese candlestick formations could not become widespread until recent times. However, they are now included in the majority of financial charting packages as a standard option and are a key indicator for establishing a method of prices and analyses, alongside the more traditional bar charts and line charts. How to read a Japanese candlestick. Japanese candlestick charts monitor price movement during a certain period of time. As the candlesticks form, they begin to tell a story of the activity in the market, as well as reflect the mood of the market during that time. Candlesticks become the sign language of the market, communicating via certain formations the future potential moves of the market, which is how profits are made, by projecting correctly where the market will go, not where it has been. Successful traders take the time to study and understand this visual language. Candlestick formations indicate clear buy and sell signals, communicating to the trader when it is time to enter the market or to get out. How well you understand candlestick formations can give you a significant advantage in the market. Japanese candlesticks formations can provide the trader with the market's first sign of changing direction, a coming U-turn, or a reversal. They will appear in the form of a single candlestick or a combination of more than one candlestick. There are hundreds of formations, yet only a handful of formations carry substantial weight when looking for a good entry point. A good entry point is described as a location where the market goes your way from the beginning. Let us see what a Japanese candlestick looks like and how it forms, see figure 4.1. Candlesticks, which are composed of full bodies and wicks, measure price fluctuations within a certain period of time. As prices move up or down from the opening, the body begins to form. If, from the opening prices move up and then close higher than the opening, it is a bullish candle. These candlesticks, in this book, will always appear empty or white, which indicates their bullish nature. If prices begin to fall from the opening price and close lower than the opening, it is a bearish candle. These candlesticks will always appear to be filled or black in this book, which indicates their bearish nature. The lines on the north and south sides of the bodies of the candles are called wicks. They monitor the highest price, or high, and the lowest price, or low, of that time period. For example, you can set your charts to provide you with 5-minute candlesticks, 10-, 15-, or 30-minute candlesticks, even hourly, daily, weekly, monthly, or yearly. Candlesticks monitor price movement against time, providing traders with 4 key pieces of information for that specific time period: the opening price, the closing price, the highest price reached, and the lowest price reached. Trading is a financial game involving two opponents: the bulls and bears. We all know that there are not actual bulls and bears trading in the market, but investors and traders who have invested either in a bullish direction or a bearish direction. Both sides have clear objectives and want the market to move in their direction. Bulls want the market to go up or rally to make higher highs, whereas the bears want to take the market down or have a dip to make lower lows. Reading a Japanese candlestick chart. Most novice traders look at Japanese candlestick charts simply because they are easy to read and understand. The numbers to the far right indicate the price and the numbers at the bottom of the chart indicate the time period. The very last candle to the right is the current candle, indicating the current price. All the previous candles, to the left of the current candle, have recorded the historic price movement during that time. As you see in figure 4.2, all the icons to the left, top, and right of the actual chart are your trading tools. How to find a high. Highs are defined as a level where the market ceases to rally and U-turns in the opposite direction. You can spot a high between 4 candles, when the 2 to the left and the 2 to the right are lower than the center wick, which is highest. A high can be considered a new level of resistance, or a higher price level achieved by the bulls that is interrupted and reversed by the bears. However, not all highs are major levels of resistance. Only highs that are higher than the current market can be considered a level of resistance, see figure 4.2. The levels of resistance noted in the above chart as R1, R2, R3, R4, and R5 become future price targets for the bulls to chase and move higher. Once they regain control of the market, they will aim to make higher highs and higher lows. The bears are maintaining control in the above chart, as the market is making lower lows and lower highs. How to find a low. A low is defined as the level where the market ceases to drop. A low in a candlestick formation is seen where there are 2 candles to the left and 2 candles to the right that are higher than the center wick, which is the lowest point. A low can be considered as a new level of support, or a lower price level that was achieved by the bears and then interrupted and reversed by the bulls. However, only lows that are lower than the current market level can be considered a level of support, see figure 4.3. The levels of support noted in the above chart as S1, S2, S3, S4, and S5 become future targets for the bears to chase and or move lower. Once they gain control of the market again, they will aim to make lower lows and lower highs. The bulls control the above market example. Understanding the different Japanese candlesticks. The art of proper communication starts with taking the time to learn and educate yourself about the various forms of communication, including the spoken word, body language, and voice fluctuations, among others. Although candlesticks may look alike, the 20 formations listed in Figure 4.4 will provide you with a solid understanding of candlestick formations and their meanings. Figure 4.4 Japanese Candlesticks. Pause the video or take a screenshot to remember the patterns. Bullish patterns. Hammer. This is a bullish line if it occurs after a significant downtrend. If the line occurs after a significant uptrend, it is called a hanging man. A hammer is identified by a small body, a small range between the open and closing prices, and a long lower shadow. The low is significantly lower than the open, high, and closes. The body can be empty or filled in. Piercing line. This is a bullish pattern and the opposite of a dark cloud cover. The first line, on the left, is a bearish line, and the second line is a bullish line. The second line opens lower than the first line's low, but closes more than halfway above the first line's real body. Bullish engulfing lines. This pattern is strongly bullish if it occurs after a significant downtrend. It acts as a reversal pattern. It occurs when a small bearish line is engulfed by a large bullish line. Morning star. This is a bullish pattern signifying a potential bottom. The star, at the bottom between the two lines, indicates a possible reversal. The bullish line confirms this. The star can be empty or filled in. Bullish doji star. A star indicates a reversal and a doji indicates indecision. Thus, this pattern usually indicates a reversal after an indecisive period. You should wait for a confirmation, as in the morning star in the previous pattern, before trading a doji star. The first line can be empty or filled in. Bearish patterns. Hanging man. These lines are bearish if they occur after a significant uptrend, and if the pattern occurs after a significant downtrend, it is called a hammer. They are identified by small real bodies, a small range between open and closing prices, and a long lower shadow, that is, the low is significantly lower than the open, high, and close. The bodies can be empty or filled in. Dark cloud cover. This is a bearish pattern that is more significant if the second line's body is below the center of the previous line's body, as illustrated. Bearish engulfing lines. This line is strong and bearish if it occurs after a significant uptrend. It acts as a reversal pattern. It occurs when a small bullish line is engulfed by a large bearish line. Evening star. This is a bearish pattern signifying a potential top. The star indicates a possible reversal, and the bearish line confirms it. The star can be empty or filled in, or it can be a doji star. Doji star. A star indicates a reversal and a doji indicates indecision. Thus, this pattern usually indicates a reversal after an indecisive period. You should wait for a confirmation, such as an evening star illustration, before trading a doji star. Shooting star. This pattern suggests a minor reversal when it appears after a rally. The star's body must appear near the low price, and the line should have a long upper shadow. Long-legged doji. This line often signifies a turning point. It occurs when the open and close are the same, and the range between dark cloud cover. This is a bearish pattern that is more the high and the low is relatively large. Dragonfly doji. This line also signifies a turning point. This pattern occurs when the open and the close are the same and the low is significantly lower than the open, high, and closing prices. Gravestone doji. This line signifies another turning point. It occurs when the open, close, and low are the same, and the high is significantly higher than the open, low, and closing prices. Star. Stars indicate reversals. A star is a line with a small real body that occurs after a line with a much larger real body, where the real bodies do not overlap, although the shadows may. Neutral patterns. Spinning tops. These are neutral lines. They occur when the distance between the high and the low, and the distance between the open and the close, are relatively small. DOJI. This line implies indecision because the security opened and closed at the same price. These lines can appear in several different patterns. Double DOJI. This implies a forceful move will follow a breakout from the current indecision. Harami, pregnant in English. This pattern indicates a decrease in momentum. It occurs when a line with a small body falls within the area of a larger body. In this example, a bullish line with a long body is followed by a weak bearish line and implies a decrease in the bullish momentum. Candlestick formations. The market can only move in three directions: up, down, or sideways. When it moves, the candlesticks provide a visual sign that monitors the strength or weakness of the market in a certain direction. However, there are two basic types of candlesticks. 1. Decision candlesticks. 2. Indecision candlesticks. Decision candlesticks are full-bodied bullish or bearish candles with relatively small wicks on either side. They communicate to the trader that either the bulls or the bears are in control. The indecision candlestick formation is exactly the opposite, with small bodies and, in some cases, no bodies at all, just a line where the open and the close were at the same price with large wicks on either side or on both sides, see figure 4.5. As the market moves, it creates visual waves, and the candlesticks form different patterns. Movements are caused by investors entering and exiting the market. When there are more buyers than sellers, the market begins to rally. When there are more sellers than buyers, the market begins to dip or decline, and when there are equal numbers of buyers and sellers, the market goes sideways. These patterns communicate the strength or weakness of the continued move. The terms rally and some dipping retracement are used for a market increase, and the terms dip and some rally retracement are used in a dip or fall in market prices. As the market moves, it waves, and the candlesticks form bullish and bearish reversal patterns. These patterns are the sign language of the market and the buy and sell signals for the traders. The patterns communicate when it is time to get in and when it is time to get out. Bullish candlestick formations or buy signals. Even though there are many candlestick formations and patterns, there are three major bullish and three major bearish patterns that offer great buy and sell signals. The three major bullish candlestick patterns are: a morning star, a bullish engulfing pattern, a tweezer bottom. These formations will appear in an uptrend as well as in a downtrend, but they are of great value and offer great financial return if spotted and traded in an uptrend. These patterns can become invaluable whenever they appear at the end of a downtrend in a smaller time frame, which many times is nothing more than the end of a retracement in a larger time frame. It is imperative to note that as the market moves sideways in a 20 to 40 pip trading range, the market may form all kinds of bullish and bearish candlestick patterns, which should be ignored. It is imperative not to trade these candlestick formations in small consolidated or sideways movement. The charts being used in this book have black and white candles. The black candles are bearish and the white are bullish. The morning star, by signal, figure 4.6a, clearly shows the formation of the morning star. What is important to note is that in the formation of morning stars, they start out with a bearish decision candle, followed by 1, 2, 3, or even 4 indecision candles before the decision bullish candle appears. In figure 4.6b, a morning star appears at the bottom of the chart, signifying the end of the recent dip. A morning star forms when you have a large bearish decision candle followed by one or more indecision candles, which are followed by a bullish decision candle that closes beyond the 60% mark, or beyond the top half of the beginning bearish decision candle. It indicates the market is U-turning. If the last bullish candle closes below the halfway point of the first bearish candle of the formation, it is a sign of continued bearish sentiment. Investor psychology behind the morning star: the bears are losing control and investors are no longer selling when you spot a morning star. More buyers have come into the market, which creates an equal number of buyers and sellers. In the end, more buyers step in and take control of the market. Bears are placed in hibernation, and bulls come out of their corrals in herds. The final bullish candle of the formation sends ripples of greed throughout the trading community, and a major rally takes place, especially when accompanied by significant trading volume. The bullish engulfing pattern, by signal, a bullish engulfing candlestick formation often signifies the end of a down move, or a reversal. It can also be the turning point or the end of the retracement in an uptrend, see figure 47a. An ideal bullish engulfing candle is formed when the candle opens lower than the close of the previous bearish decision candle, engulfing the previous 2 or 3 bearish candles. This is a strong sign of a U-turn. The bulls are clearly taking control, as seen in figure 47b. Investor psychology behind the bullish engulfing pattern. The wind has been taken out of the bears' sails, and the bulls have arisen with increased stamina. Traders with short positions make a quick dash to cover their exposure, and their rush to exit their positions adds power to the creation of the pattern. The volume on the uptake component shows that the majority of traders have changed camp from bearish to bullish within the duration of one period. Tweezer bottom bullish formation, by signal. Tweezer bottoms form when bears lose control. Buyers step in and create an environment of equal buyers and equal sellers, which forms 2 or more indecision candles. Figure 48a shows the formations. When the market has been falling and a clear decision has been made by the bulls to take over, tweezer bottoms are formed. The market continues to move down, and bearish candles are formed. All of a sudden, an indecision candle appears, which means more bulls have started buying. We now have equal buyers and sellers. A tweezer bottom formation starts with a bearish decision candle, followed by perhaps 1, 2, 3, even 4 indecision candles, as seen in figure 48a. When bears attempt to take prices lower and bulls step in and buy more than bears, a long wick on the south side of a small-bodied candle forms. A second attempt is made by the bears to take prices lower, with the same results, leaving another indecision candle with a long wick on the south side of the small body of the indecision candle, next to the last one. The lows of the 2 candles, as displayed by the wicks, are usually at the same price or within a couple of pips difference, which now creates a new level of support. The tweezer bottoms scream out, "This is the end of this down move and the market is now getting ready to rally." Anyone wanting to make a profit in this next rally needs to start buying right now. Why? Because higher prices are likely to follow the formation of tweezer bottoms, as you see in figure 48b. Investor psychology behind the tweezer bottoms. The bears have created lower prices, which have been tested, and new buyers have entered the market. As traders note more bullish participation, a rally is implied. The bears were unable to acquire the interest of more sellers and were not strong enough to hold prices down. Several attempts for lower prices failed, as evidenced by the long wicks on the south side of the small-bodied candles. The tweezer bottoms are a sign of selling exhaustion. It is important to note that the tweezer bottoms do not need to be side by side, they can be several candles apart, as long as the lows of the wicks are close to each other, with only a difference of a few pips. Such a formation will create a level of support. Bearish candlestick formation or sell signals. The 3 major bearish candlestick patterns are: an evening star, a bearish engulfing pattern, a tweezer top. These formations will appear in a downtrend as well as in an uptrend, but they are of great value and offer great financial return if spotted and traded in a downtrend. These patterns can become invaluable whenever they appear at the end of an uptrend in a smaller time frame, which many times is nothing more than the end of a retracement in a larger time frame. Once again, it is imperative to note that as the market moves sideways in a 20 to 40 pip trading range, the market may form all kinds of bullish and bearish candlestick patterns, which should be ignored. It is imperative that you remember not to trade these candlesticks formations in small consolidated or sideways movement. The evening star, sell signal. Figure 49a shows what an evening star looks like. What is important to to note is that it starts out with a bullish decision candle, followed by perhaps 1, 2, 3, even 4 indecision candles before the decision bearish candle appears. In figure 49b, an evening star appears at the top of the chart, signifying the end of the recent rally. An evening star forms when you have a large bullish decision candle, followed by one or more indecision candles, which are followed by a bearish decision candle that closes beyond the 60% mark, or beyond the bottom half of the beginning bullish decision candle. It signifies the market is U-turning. If the last bearish candle closes above the halfway point of the first bullish candle of the formation, it is a sign of continued bullish sentiment. Investor psychology behind the evening star. In figure 49b, the bulls start out rallying like a rocket going to the moon, driving prices higher. Initially, it seems nothing can stop them. These initial candles reinforce the bullish sentiment. All of a sudden, a spinning top appears, a sign of indecision, in the form of a small indecision candle. It is quickly followed by a bearish decision candle and the session quickly U-turns. The bulls lose control and investors are no longer buying. More sellers come into the market, which creates the dip in prices. Bulls run for cover and begin liquidating their bullish positions, which adds to the bearish momentum. In the end, more sellers step in and take control of the market. Bulls are corralled and bears come out of hibernation. The final bearish candle of the formation sends ripples of fear throughout the trading community and a major sell-off takes place, especially when accompanied by significant trading volume. The bearish engulfing pattern, sell signal. A bearish engulfing candlestick often signifies the end of an up move or a reversal. It can also be the turning point or end of the retracement in a downtrend, as seen in figure 410b. As prices continue to rally and the charts form small decision bullish candles, all of a sudden, a very large decision bearish candle appears and literally engulfs the previous 1 to 3 bullish candles, see figure 410a. The prototypical bearish engulfing candle occurs when the open of the bearish engulfing candle opens higher than the close of the previous bullish decision candles and engulfs several previous bullish candles. This is a strong sign of a U-turn when the bears are taking control. Investor psychology behind the bearish engulfing pattern. On an emotional level, a devastating blow has been swiftly delivered to the bulls when an engulfing bearish candle appears. Those feeling optimistic and buoyant about the upward market direction have been proverbially kicked in the teeth. Traders with long positions make a quick dash to cover their exposure, and their rush to exit their positions adds power to the creation of the bearish engulfing pattern. Within the duration of one period, the majority of traders have changed camp from a bullish perspective to a bearish orientation. Tweezer top formation, sell signal. Tweezer tops form when bulls lose control. Sellers step in and balance out the numbers of buyers, which forms 2 or more indecision candles, see figure 411a. In figure 411b, the market has been rallying, but a clear decision has been made by the bears to take over, observed via the formation of tweezer tops. As the market was moving up, bullish candles were forming. Then all of a sudden, an indecision candle appears, which means more bears have stepped in selling. There are now equal buyers and sellers. A tweezer top formation starts out with a bullish decision candle, followed by perhaps 1, 2, 3, or even 4 indecision candles, as seen in figure 411a. A tweezer top appears when the bulls attempt to take prices higher and bears step in and sell more than the bulls, creating a long wick on the north side of a small-bodied candle. A second attempt is made by the bulls to take prices higher, with the same results, leaving another indecision candle with a long wick on the north side of the small body of the indecision candle next to the last one. The highs of the two candles, as displayed by the wicks, are usually at the same price or within a couple of pips difference, which now creates a new level of resistance. The tweezer tops scream out, "This is the end of this uptrend move and the market is now getting ready to dip." Anyone wanting to make a profit in this next dip needs to start selling right now. Why? Because lower prices are likely to follow the formation of this pattern, as shown in figure 411b. Investor psychology behind the tweezer tops. Bulls have made prices higher via their rally, however, bears, or more sellers, have entered the market. Indecision candles have formed next to each other and, in this case, 3 in a row, as seen in figure 411b. With such resistance, the market collapses. With increased bearish participation, bears enter the market charging, and the result will be a dip. Shortly after the dip, the bulls try one last time to see if they can attract any more buying interest. The failed test by the bulls sends out the alarms: buyers are not strong enough to hold prices up, everyone sell. The bulls are exhausted, and the bears take control. It is important to note that the failed attempt of the bulls to create higher prices formed the tweezer tops, although they do not need to be side by side. Trading candlestick patterns. Learning how to identify and trade candlestick formations can be extremely useful in identifying potential coming patterns. However, although these patterns offer great trading signals, as seen in figure 412, you should not trade these candlesticks patterns on their merit alone. Your common sense is an excellent guide as well. For example, your common sense should tell you that, in a downtrend, only trade bearish candlestick formations, not bullish. Why? Because you are trading in the direction of the trend where the market strength is. You have a greater probability of the market moving in your direction after entry versus fighting against the trend. Obviously, you would do the opposite in an uptrend. When you trade in the direction of the trend, you will always have the market movement on your side, pushing the market in the direction of the current trend. In trading any candlestick formation, you must wait until the last candle closes before you enter the market, because the market may not necessarily react immediately after the candlestick formation has formed. Keep in mind that as long as you have your stop-loss orders in place, you are protected. The market will move on its own timetable, not yours. You have no control of the future movement of the market. No one knows where the next pip will go. As long as the candles are above the outer moving uptrend line, you should enter buying bullish candlestick formations and exit selling bearish candlestick formations. The opposite applies in a downtrend. When the candles are below the outer moving trend line, enter selling bearish candlestick formations and exit buying bullish candlestick formations, as shown in figure 412. Trading is a game of probabilities, and to put the probability of success in your favor, it is always helpful to compile more than one piece of evidence that the market will potentially U-turn and move in your direction at the price level you enter. In other words, success is increased if you have more than one educated reason to enter the market. When you have more than one good reason to enter a trade, that is what is called creating a convergence. This is, in essence, nothing more than building a case as to why the market is going to turn at that location. Why is it that all of a sudden, at one number, the market creates a candlestick formation and changes direction or U-turns? It is almost as if there was a conspiracy taking place among a group of traders. We all know that is impossible, because there is no Forex building or pit filled with Forex traders who could manipulate prices. My sense is that nature must stay in balance, and nature takes whatever course it must to remain in balance. As human beings, we are part of nature, and because we are the ones trading in the market, it is our buying and selling that make the movement in this market. The market is part of nature and will take whatever course it must to remain in balance, as you will see in Chapter 9. Conclusion. I don't consider myself a religious man, but I am a spiritual man. I believe there is a greater power, perhaps a force of nature, orchestrating everything and everyone's outcome in this world. Nature can provide signs on our path to success of which I know most people never think about it. However, those individuals who try to understand it and tap into the potential it holds are the people who will benefit most and live fulfilling and wonderful lives. Conversely, those who just exist, living on automatic, never thinking about it, slowly become the victims of nature's balance because their focus is on survival. I thought about all the trading opportunities one had missed over the years, due to the fact that I was not educated or ready to read the signs of success the market provided, like the evening stars and morning stars. If learning to become a successful trader is something you really want to achieve, you will need to prepare yourself to read the signs of the market. It is there you will find success. Smash subscribe plus like plus share equals more content like this.